Hey everybody, and welcome back to Investing with Wesley. Today's episode, I want to talk to you about the future of our economy, and I don't mean the stock market, I don't mean an eventual death spiral or anything doom and gloom. I just want to talk to you about our economy as a whole and what I think the effects are going to be when we start feeling the effects of all the deflationary pressures that we've been putting into the economy over the past year. Today's episode, I want to talk to you about FDIC insurance. I want to talk to you about bank bailouts, and more importantly, bank bail-ins. Also, what the difference is. So with that being said, let's get into it. Okay, so for starters, let's define what these three things we're going to be talking about today is. We're going to start with FDIC. What is FDIC? You may have seen it whenever you go to the bank. They'll have little stickers posted everywhere that this institution is FDIC insured. If it's not, you definitely should find a bank that is. But you may have seen it around, but you might not really know what it is. Well, the FDIC stands for Federal Deposit Insurance Corporation. And basically what it is it is a federal entity that insures your deposits at the bank. So even if the bank fails and goes out of business or goes under, you still have the money that you put in that bank because the cash that you gave the bank was insured through the FDIC. The FDIC actually got its start in the 1930s after the Great Depression, and no one wanted to use the banking system because no one trusted it. So the federal government stepped in and did what they always do. They tried to convince the public that this thing will protect them and that it is now safe again to use the banking system. And forever and a day, that was the honest truth. The FDIC insurance program is amazing because yeah, some banks and some money managers don't handle their finances appropriately, and with the free market, people go in and out of business all the time. But just because your bank went under doesn't mean all of your money needs to go with it. Another important thing to remember is that the FDIC insurance only covers deposits up to $250,000. So if you have more than $250,000 in a bank account, you're only covered for that $250,000. Anything in excess of that is not covered, and if that bank goes under, you would just lose that money. Okay, so now that we know what the FDIC is, let's talk about bailouts. Now, everyone knows what a bailout is, or at least they've heard all the media about it. Bailouts are probably the most famous way to avoid a catastrophe in a particular industry or at a particular business. A bailout is simply when a business, individual, or government injects capital or resources to another business entity, government, in order to prevent them from going bankrupt. So the most famous case is in 2008, the great financial crisis, when all the big banks and hedge funds were hemorrhaging cash and all on the verge of going out of business. The government stepped in and gave all these financial institutions a bunch of cash that was needed to prevent them from going bankrupt. A more modern case is the coronavirus pandemic. Entire economies all across the globe were completely shut down. No businesses were able to run because of fear of spreading the contagion, and the government had to step in to avoid a full-on economic collapse and shutdown. They issued various stimulus programs, injecting it directly into the economy, buying mortgage-backed securities, buying US treasuries. They even sent it to certain individuals in the form of stimulus checks. All of that can be considered a bailout. The first one in the global financial crisis was bailing out the financial institution. The second one was bailing out the economy as a whole, which is why we saw the inflation numbers way bigger than what we saw in 2008. Now, the one important thing to know when it comes to bailouts, especially when the government is bailing something out, is that it is always inflationary. The government is already operating on its max. They're already overspending, so they have no real tangible money to give to anyone else. That means whenever they bail something out, they have to print money and then give that money to whatever entity it is they're trying to bail out. And obviously, we've learned that printing money causes inflation. So when the government performs a bailout, it's always inflationary. Now let's talk about bail-ins, because bail-ins aren't really that popular because bail-ins haven't yet occurred, at least not here in the US. But the name and the thoughts and the topic keeps being brought up over and over again. So that usually means it's something we need to pay attention to. And I'm glad I did, because like I said, creating this video and researching this and seeing all this led me to make this video. Bail-ins accomplish the same goal that bailouts do. They bail out or provide relief to an institution by sending money at it. But the real difference is where they get the money. So in a bailout, money is provided to the failing company, whereas in a bail-in, it is honestly stolen from you. Bail-ins provide relief to institutions by requiring the cancellation of debts and deposits to creditors and depositors. So what does that mean? Well, basically in a bailout, some outside source, usually the government, is printing a buttload of money, giving it to this corporation, this company, to prevent them from going bankrupt. And all of the creditors, the people who have lent that company money, or the people that are doing business with that company that are owed something in return, all those creditors are protected because this outside entity is giving money to them. But in a bail-in, it is the creditors that take the loss. No outside entity is coming to the rescue. In the financial sector, when it comes to banks, bail-ins will eventually be the solution, and honestly, that thought concerns me, and I hope I'm wrong. But when it comes to financial institutions, a bail-in can happen, meaning the government's not gonna step in and give the financial institution money. Instead, the financial institution is just going to take everyone's money in excess of the FDIC limit. So if you have $500,000 in your checking or savings account, or a combined value of such, then they're gonna take $250,000 and to leave the remaining $250,000 that's covered by the FDIC insurance in your account. Now, you might be thinking to yourself, how could they possibly do that? That's my money. And it's really how the banking system works. A lot of people in their head think that a bank is basically a storage facility for other people's cash and wealth. And in the old days, that's exactly what it was. But today, how it works is more just based on a system of ledgers. My cash, or the deposits that I give the bank, are liabilities to the bank's ledger. Whereas any loan that I get from them, or any promise to pay, are considered assets on their ledger. So if I owe them money, that's good for them. It's a liability for me, but an asset to them. But if I'm giving them money in the form of my deposits, it's a liability to them and an asset to me because they're keeping my money safe, or are supposed to be, and I can get that money and it's redeemable whenever I want. So in this sense, I am a depositor or a creditor to the bank. So in the event of a bail-in allows the bank to cancel all its debts or its obligations to its creditors or depositors. Now, the reason I say this is a potential reality that I hope I'm wrong about is because we're experiencing really high inflation with really high interest rates, and it looks like we're gonna have to repeat the 70s and skyrocket our interest rates in order to get inflation in check. Now, with that being said, it would make no sense for the federal government or any other entity to print billions, if not trillions of dollars yet again to bail out the financial system. Instead, when banks start going under because businesses start going under and are no longer able to pay their debt burdens to the banks, at that point, banks will no longer be receiving more deposits, because if incomes for businesses fall, then that also means incomes for individuals fall because of how the economic machine works. If you didn't already know how the economic machine works, I've made a video that I'll put up here in the card section so you could watch that and kind of get a backstory on what I'm talking about now. As interest rates rise, it means there's less disposable income, which means people are spending less money, which means businesses are earning less money, which means the businesses are no longer earning the same amount, so they have to do cutbacks, which means individuals working for that business earn less, and if you earn less, you spend less, and it's a never-ending cycle that keeps going down. So if businesses are earning less and more money is supposed to be going to servicing their debts, they'll eventually default, which means the banks are going to default on their obligations because they're not receiving any interest payments coming in. Their assets are all defaulting. And that is going to lead to some form of bailout. Now, I use the term bailout how we all use it, because like I said, I don't think a real bailout is going to happen. It would not make sense for the government to create even more inflation to save the banking system. Instead, they'll probably perform bail-ins, take everyone's money up to the max that they can, and when that's not enough, banks will start shutting down. Now, here's the second part of the really scary information. A lot of individuals probably aren't going to have $250,000 plus sitting in their accounts. If you are that wealthy and have that kind of funding lying around, then you need to get yourself a new advisor, because there's way better things that you could be doing instead of leaving it in just deposit accounts. But that's neither here nor there. Most of us probably are going to be under that FDIC insurance limit. But why does FDIC matter? And that's because when banks start shutting down, when banks start going out of business and going belly up, people are going to be claiming their FDIC money. But here's the thing, when you look at the FDIC website, you'll see that they only have about $125 billion to give out to cover a total insured depositor load of about $9 trillion. So somehow they plan on making $125 billion cover $9 trillion. The math just doesn't add up. The FDIC is basically insolvent at this point. They can no longer cover their promises to people and institutions that are depositing into FDIC insured banking systems. So not only will the bank system rob your money in excess of $250,000, but the longer you wait to pull your money out of the bank, the less chance there is that the FDIC insurance will be able to kick in, because there's only so much money and there's not enough to cover all of its deposits. Now, I don't want this to sound like I'm telling you to get all of your cash, everything out of the banks, out of all the banking systems in general, and put it under your mattress. But I do want you to be made aware that there is an inherent risk to leaving your money inside these financial institutions, especially things that are FDIC insured. I mean, I guess since they're FDIC insured, there's a chance that you can get your money back if you act quick enough when compared to an institution that's not FDIC insured. But these are definitely things that you need to be made aware of and that you need to constantly keep in the back of your head when making your financial decisions. I've been telling you for over a year now that if this economic depression gets so severe that it affects the financial institutions or the banks while inflation remains high, like we're starting to see right now, then the safest place you could be is wealth preserving assets like physical gold. But really, the sad thing is, even physical gold and the spot price of gold isn't a 100% bulletproof place to put your money, because the Federal Open Market Committee across all their meetings keeps messing and recalculating the gold prices, which is why you see gold prices going down over the past few weeks. It's the same thing they've been doing to silver for decades. So, okay, if you can't put your money inside the bank and you can't put your money, at least not a large sum of it, into gold, then where can you put your money? And honestly, for me, at least now, the answer that I'm doing for myself and my finances is to remain the course that I've been remaining on. It is to broadly diversify across different asset classes and economies, to even go international, into real estate, into things like gold and other commodities, to be fully diversified. That way, if the financial institutions collapse, or if precious metal markets collapse, or if the US economy collapses and not the rest of the world, there'll be pockets of my investments and pockets of my money to be safe. I've been saying it for years, diversification is not the fastest way to grow money, because the more you diversify, the less you are to grow the value of your accounts. But on the flip side, the safer your overall money will be. I hope you got value in this video. If you did, please remember to like and subscribe. I really hope I was able to warn you soon enough to take a look at your FDIC insurance, take a look at how much money you have in your bank accounts, and overall take a look at how much you have in all of your accounts and recalculate and make sure you're diversified. I really hope I helped shine a big light on the potential risks that we face as a country. And like always, if you ever had a question, comment, or just wanted something addressed, you can message me on one of my social media accounts, Facebook, Instagram, or Twitter, or just leave a comment down below. Either way though, the choice is yours, and I'll see you in the next episode.